Hey, greetings and thanks for joining Macro to Micro Power Hour. I'm Samantha LaDuc, founder of LaDucTrading.com, joined with our Macro Advisor Edge Manager, Craig Shapiro, on Fed Day, post-Fed Day, and we finally got some selling. So Craig, kind of review what we just witnessed, both from QRA this morning, right straight through to the FOMC release and Powell at the podium.
This episode is presented by Edge. Edge is our pro-to-pro advisory service, which is all about the macro with a focus on one-to-one engagement with the hedge fund manager, Craig Shapiro, and direct access to LaDuc Trading founder, Samantha LaDuc. For more information about Edge, visit www.laductrading.com/edge.
Yeah, I mean, we titled this webinar Macro Super Bowl, and certainly today, was that. And this week, for both the Fed and Treasury and the data and the earnings, this is the week. We're getting some fireworks. So I think let's start with the Treasury real quick, just because I think it's a little bit cleaner. We can talk about the Fed after, but just with respect to Treasury and the quarterly refunding announcement, basically what we got on Monday afternoon was an announcement from Treasury that suggested that less borrowing overall was going to be needed in the calendar second quarter, net borrowing of $200 or so billion. And the market kind of took that to believe that it would ultimately mean less duration issuance. And so there was less concern about this morning's 8:30 release. What I had been mentioning in our chat and our channel was that the 8:30 release was certainly way more important, and that it wasn't out of the woods yet about whether or not she was going to be actually lowering the coupon issuance. And I think because in the second quarter we have significant tax receipts that come in because April is part of the second quarter, and so it's more likely that we were going to get negative bills issuance and higher coupon issuance. I still thought that was the case, and that is ultimately what we got this morning. We heard from Treasury that there will be a net increase about $450 billion of duration supply growth in the calendar second quarter versus the calendar first quarter. And so there is a significant step up in duration increase that will be offset to some degree by about a $245 billion of negative net bills issuance. So they're going to be retiring close to $250 billion of bills in the quarter, all assuming that what they forecasted now actually comes through. And obviously there's significant risk their forecast, and I posted that in our chat too, that the Treasury often is wrong on their initial assessment for their borrowing needs by what could be hundreds of billions of dollars. So if they're wrong on tax receipts, they're going to be issuing more bills later on in the second quarter. So that was the lay of the land from the Treasury's perspective. And I think we didn't really get much in the way a Treasury fixed income pricing move today, at least in the morning, I think because of this NYCB bank issue, which I think kind of struck people or took people a little bit off guard. No one's really looking for a regional bank blow up. And I think it just immediately, people seeing that stock down 40-50% and talking about issues on loan loss and a variety of other things kind of opened up this narrative potentially of, well, that we're going to have a regional banking crisis again. The Fed's going to cut rates, and that's going to be negative. And it almost seemed like it offset the Treasury announcement. I don't think that's going to last. I think NYCB is a standalone issue. It bid for and won the auction for these signature bank assets. It has its own problems or not. And I don't think this is some sort of systemic anything. So I don't think the reaction from the bond market from that really made any sense. I mean, there was some tepid or more tepid labor data this morning with ADP coming in a little bit lower than expected, and the ECI, which is Fed watched labor indicator on wages, both came in a little bit less than expected. So that might have helped.
Very little.
Very small. And that
employment cost index rose 0.9. They were expecting 1.
Yeah. So the combination of those two, those things, I think probably led fixed income to be stronger to start the day than I otherwise would have thought. And so we also had, big tech earnings after the close last night.
That was more interesting.
Which didn't meet expectations. And so I think the fact that the Nasdaq was also selling off probably also was another reason that the bond market was rallying. And so it seemed like the QRA information came in line with what I would have thought, which was more hawkish on supply than what the market was pricing, but the reaction in the bond market was trading other things, at least for now. But the reality is that we are going to have a significant pickup in net duration issuance growth, literally every month now for the next 4 months. So in February, again in March, and again in April, and we'll see about May at the next meeting. There was some discussion that maybe they're done, and that's possible that they may be done increasing the issuance. But for the next 3 months, for sure, we will have growth in duration issuance. So we'll have to watch all these auctions as they come through. Kind of shifting to 2 p.m. and the Fed. Look, I mean, my view had always been that with financial conditions as easy as they had become and the significant loosening of financial conditions that we've seen over the course of the last 3 months, it was going to be difficult for the Fed to embrace an imminent rate cutting regime and adding accommodation as soon as March. And so one thing I had pointed out in the lead up to today was I thought it was possible that they were going to remove the word financial from the statement with respect to financial conditions tightening. And I thought if they did that, that was going to be a pretty hawkish development, because it would mean that in the Fed's eyes, the financial conditions really are no longer tight, and that I believe that financial conditions being tight is a precondition for cutting rates. So in my view, if they were to remove that word, it would suggest to me that they were going to be pushing, that would be pushed back aggressively against the March cut. What did they do? They removed the entire statement of financial and credit conditions being tight, which was a shock really to me. And once I saw that put in our channel, this is a hawkish statement. This is basically a sell risk type of comment, because I think that means that there is a precondition. I think there's a precondition that suggests that the Fed needs to see financial conditions and credit conditions being tight in order to start their rate cutting regime. They want sustainable evidence that inflation is moving down to 2%. The amount of information they have so far is not enough. This is effectively, and what I mentioned was, I think this took March off the table right at that point. What we saw, subsequent to that is, a lot of crazy trading that often happens when Powell speaks. We have less than the night, you have 90 minutes left in the day. So you have zero data expiry stuff, and you have all sorts of, gamma positioning and the like, and trading around every one of his words. And, look, I mean, during the press conference, the statement transcript that he read was very much in line with what he had said last time. But he did say, we are unlikely to, be hiking anymore, which really wasn't much of a surprise. And then in some of the early questions, it made it seem as if maybe he wasn't going to be as hawkish as the statement. Powell is, often gets mixed. Not that he gets mixed up. He just, the questions that come from the Nick Timirailses and Steve Leisman's often have dovish bias, and he winds up answering the questions suiting the dovish narrative. And so I think that helped bring, an intraday rally from, I don't know, what was it, 235 to 250 or so. There was a very aggressive move higher in risk, as maybe some people, thought he was, still embracing the March cuts. But then he specifically was asked about it and basically said, yeah, as we're seeing things right now, we don't expect a cut in March. Again, I thought that was a shocking statement. I didn't expect him to say that. Maybe he was looking at his Bloomberg, while he was answering questions and saw the market was ripping on him. I don't know, that I'm being facetious, but he did basically say, March, assuming that this is the data that we have and things don't get better or worse, don't get worse from here, we're not going to be cutting in March. And then he went on to say, with respect to QT and the tapering of QT, that they really only had initial discussions today about that. They will have in-depth discussions at the next meeting, which means a decision is not coming until after the March meeting, maybe at the May meeting, possibly at the June meeting. And I think the tie-in between QT and the Fed with Treasury is that when you have negative bills issuance coming in the second quarter, you are not going to drain the RRP as aggressively in the second quarter as you have been in the fourth quarter of last year and in the first quarter. As a matter of fact, you're likely to see potential for money to go back into the RRP because the RRP is earning 5.3%. And so if we're not seeing an increase in bills issuance, we're actually seeing a decline in bills issuance, you may see money flow back into the RRP. That slows down the impetus for the Fed to feel like it needs to do QT tapering very soon. And so that's another pushback against what the market had been pricing, which was an increased thought that QT tapering could happen as early as March. I think that's off the table now too. So really what you had was a macro trifecta, or on today of negativity. Really, you had a Treasury announcement that was more hawkish than the market was expecting after Monday. You had corporate earnings from big tech, which were fine, but clearly we've traveled a long way into these events, and the outlooks were not as robust as maybe market was anticipating. You had earnings that didn't come through. And then lastly, you had a hawkish Fed that pushed back against March cutting and pushed back against an imminent taper schedule. So you really didn't have anything going for a market that was, as I've been pointing out, as overbought on big cap tech as we've seen really over the last 15 years, based on some of my proprietary technical readings. I've been pointing that out on XLC, on Microsoft, on big tech. So we were set up for something to go wrong. This is, day one of that, I think. I think we're going to see a continuation of this risk-off dynamic. Finally, vol has started to come a little bit unpinned, moving higher.
Yep.
And now we're back into a negative gamma position with systematic flows that I've been pointing out from the tier 1 data is basically at, I'm not going to say record highs, but we are as long, systematic flows are as long as they've been really since, pre-COVID. So folks are long, systematic flows are long, retail is long, everybody's long, and you got a bearish corporate earnings outlook, you got a hawkish Fed, and you have a Treasury that's going to increase duration issuance. I'm worried here about where things are going.
Let's talk about some of his statements. Anything that kind of is very obvious to you and others that were surprised. He kind of started that inflation remains above goal, depends on how he's measuring. Now, we talked about the PCE, the 3-month, the 6-month, year over year are firmly below 2, but the 12-month is not. So we basically sometimes move in that goalpost. But what are you saying he's measuring inflation by, not CPI?
Yeah, look, I think what he mentioned was that they're not, and Waller had said something very similar, which is they're not looking for a one touch of 2%, right? They're looking to get to 2% core PCE on a sustainable basis. And so, yes, it's true that the last 3 months have been lower than 2%. Yes, it's true that the last 6 months are basically at 1.9%, but it's not true that there's proof that we're going to stay there yet. And so I think he just is looking to buy time. And this is something that I've always discussed about the Fed, is that they are in the buying time business in order to get closer to achieving their mandate. And by buying time, what I mean is that when vol gets too low, they need to reintroduce vol into the markets and into the economy. And the reason that they do that is because they don't want risk assets being up so much that we run the risk of inflation expectations becoming unanchored again and inflation reaccelerating. And so they don't want to see, wealth effects run unabated. And, we're talking about inflation again later this year. But on the flip side, when vol gets too high, they often seek to dampen vol so that we don't run into a situation where we have a deflationary bust, where we have too much unemployment that ensues. And so, look, I think with the market at 4,900 plus, and with financial conditions as easy as they've been on the Chicago Fed metric, financial conditions now are easier today than they were at the start of the tightening cycle in 2022. On the Goldman index, they're well looser than they were in July. And on in the Fed's other metrics, they're reasonably looser. So I think the Fed said financial conditions are loose, growth is good, employment is fine. Like, we're not going to be providing additional accommodation here to the extent the market is pricing, because we just don't want to be in a position where inflation reaccelerates later this year. We just rather be sure. So give us more time. And look, if inflation continues to print weaker in the next month and the next month, then they will commence that rate cutting cycle, but they don't need to do it now. And so the market front ran them, as it often does. And this was a little bit of a smack back as a reminder to not get too far ahead of things. So I think that is the message on inflation. And I mean, look, he said, he was asked the question, if inflation were to reaccelerate, what would you do? And he said, that's not our expectation, but if it did happen, we would tighten. What he did say he was concerned about is inflation settling at a level higher than 2%. That is his concern. That is the concern of the Fed. That is this last mile concept, which, some on the Fed think is not going to be a big deal. Clearly, others think is going to be a big deal. And it seemed like the Fed is saying, we want to be sure. We don't want inflation to settle at 2.5 to 3. We want it to settle at 2. So we need more time. We need more data. And we're going to stay, tighter for longer until until we're sure. And what is sure? It's like, we'll know it when we see it, to quote a famous Supreme Court case from a long time ago.
Literally. All right. So what about the money quote where he stated, we don't know where neutral rate of interest is? Yeah,
look, I mean, he's not most academic of Fed chairs. I don't think he necessarily buys into a lot of these esoteric concepts of things that are hard to know, quote unquote, know. I think what is clear is that the economy has been performing better than expected, given the level of tightening that the Fed has done. And that has been a surprise to not only the Fed, but to the market and to literally everybody. And we've discussed, a variety of reasons of why that's been the case. And it has to do with the locked in low rate borrowings that households and corporates did post-COVID, and the fact that the U.S. government is the biggest borrower and they're paying higher interest. And so they are paying out that interest to consumers, which is assisting consumption, running 7-8% deficits, which has helped keep the economy better than expected. And so I think for me, I see more pressure, structural inflation pressure, which likely means going forward, which likely means the neutral rate is higher. But the Fed's not, willing to, or at least Powell himself's he's not willing to say it specifically. And so they'll just, keep punting on that. It's possible that the neutral rate is higher. I think it's certain that the neutral rate is higher, but I don't think that's something that is top of mind or a driver of policy right now. I think the more important driver for policy is this idea of real rates and this normalization concept, and that they need to be cutting in order to prevent becoming increasingly restrictive. And it did seem a little bit, there was a little push. He pushed back against that a little bit today. I mean, he basically said, look, it's not so mechanical that if inflation falls this month that we cut this month, right? He's like, we're looking at this holistically over the course of the year. And so, yes, expect us to do this over time, but, don't expect us to do this at every meeting or on every inflation print. I think that was what he was trying to convey, which is different than what the market is pricing, which is effectively, a cut at every meeting starting in March. And I think that was not something that's not something that the Fed is embracing right now.
How important is NFP tomorrow? I'm sorry, Friday morning.
Friday. Yeah, look, I mean, I think, he was asked about whether or not the Fed would consider accelerating its loosening and cutting if the labor market showed deterioration. And so I do think there is, obviously, non-farm payrolls is always important. So ADP was a little bit lighter. The JOLTS data came in better, which suggests maybe things are, could be better for this month. Look, I think if it's a strong print and the labor market continues to show positive momentum where wages are robust and jobs are plentiful and job creation is high, then there's no way they're going to cut in March at this point. I think if it's a very weak number, you could get into a situation that would bring back the March cuts. But then they have to ask the question, is the economy deteriorating actually more rapidly than we think or we know? And is that ultimately, is a reason to buy? risk on that? I'm not sure. I think in that environment, I think the dollar would get hit on a very weak number. I think gold would rally. Bonds probably would rally. I mean, stocks probably would have a relief rally, but I don't know how sustainable that would be. But yeah, I think if it's a really crappy number, you could bring back in this idea that maybe they need to, consider cutting in March. It's not expected. I think right now, let's see, expectations for
they went down to like 34%.
Yeah, no, I was just saying that the expectation for NFP on Friday is 185,000 versus 216 last month, and wages ticking down to 0.3% and 4.1% year on year versus 0.4 and 4%. Look, I mean, if we had a shocker of a number, a negative number, or a very low number, then yeah, I think we would take the odds of March back up, but I don't think anybody really expects that. Unfortunately, this time we won't get services employment before the NFP. Usually that's a good tell. That services and ISM is on Monday, so we'll just have to see claims tomorrow. We have to make a determination about whether or not that number is going to come in. But I think it seems like it's going to come in fine.
All right. So what are you looking at for event risk next? Since we've gotten now this QRA and FOMC out of the way, we obviously have 3 major earnings reports that came out Tuesday: AMD, Google, Microsoft. We have 3 other major reports Thursday: Apple, Meta, and Amazon. And then, this is some energy plays, of course, Friday morning. But for the meat of earnings season done after this week, in large part, where to from here on macro-driven event risk? And then I want to open it up also for, this is macro to micro power hour, so Q&A. Definitely hit us up with questions, and I'll also show you some short-term charts of interest that I think, anyway, are some really good targets for prices right now. But right now, next few days, what's your inclination? And then into the middle of February for event risk.
Yeah, look, I mean, tomorrow we get ISM tomorrow, regular manufacturing ISM tomorrow, and the flash number was a pretty good number. So, I mean, are we going to start to see manufacturing recover? We'll see that tomorrow. We get claims tomorrow, and then on Friday we get NFP. And we get the UMich surveys for sentiment and for inflation. So those are always, interesting to see what the consumer confidence numbers look like and inflation. And look, it seems like confidence has started to improve in these recent sentiment indicators, suggesting that maybe the economy continues to do better than expected. So that's important. Monday, we'll get services ISM and the senior Fed loan officer survey, which is another big data point that goes into kind of the Fed calculus. And then on the 9th, we get these CPI revisions that Waller said are going to be important. So that will look at, kind of what last year's inflation actually was with some changes in methodology. So if there's any big outliers on, what inflation was versus what they thought it was, that could, be impactful for, the next meeting. And then the CPI is on the 13th. We also, in the month of February, we get Powell speaks to Congress in the annual Humphrey Hawkins testimony. So to the extent that he is looking to give a message about future rate intentions or future balance sheet intentions, it's possible he would use that as a forum to do that. So you could imagine a scenario where risk is off, as I predict, for the next few days or weeks, and we get to a point where he's scheduled to speak and he decides to speak more dovishly. But I think we're in the place now where this is a bit reflexive, in that in order for Powell and the Fed to deliver cuts, we need to see risk come off. And so, yes, we could get a March cut, but we're not getting a March cut at 4,900. I mean, if we were at 4,600 or 4,400, yeah, I think we could get a March cut. So I think that we are kind of going to now search for the Fed put level. I mean, he basically said March is off the table, assuming these conditions. Well, now the market will go and search for the types of conditions that are necessary to create a cut again. That's what the market does. It acts like a petulant child and in constant need of incessant liquidity. And when the Fed doesn't give it to them, it cries and risk gets sold, and we find levels, lower that kind of bring back the odds. So I think that's what we're going to get. The other thing I mentioned tomorrow is on data. Tomorrow we get Apple, Amazon, and Facebook after the close. So look, we're going to be basically through earnings by the end of tomorrow for all intents and purposes. I mean, NVIDIA is later in February, which obviously will be important whenever day that is.
Yeah.
But, share buybacks window will reopen again. I did think it was interesting that Microsoft actually in the last quarter share repurchases were down significantly. I believe there was actually net share creation in the quarter from stock options over the buyback. So even Microsoft has kind of came out and said, yeah, maybe our stock is overvalued here. Like we're not going to be buying back as much stock with trading at 40 times earnings and the like. So maybe the buyback support isn't as robust in this window because stocks are just too high. At least tech stocks are too high. So look, I think we had always kind of talked about the Jan expiry as a point where markets could top out.
Yes.
And the window of weakness kind of opening up, but with the
We're there.
acknowledgement that we needed to also get through this macro Super Bowl week of earnings, Fed and Treasury. Well, we are now almost entirely through it. We've traveled a long way. Folks have bought all the way up. And now it seems to me like we've been disappointed on what Treasury is going to do on coupon issuance for the next 3 months. We've been disappointed about what the Fed is going to do versus expectations of cutting imminently. And we're also being disappointed by the earnings that are coming through, at least right now, so far for big cap tech. When you combine that with systematic positioning being as long as we've seen in quite some time, and the market very close to flipping back, basically right at a negative gamma position, we are potentially leading, I think, here to a fairly adversarial, market environment here for the next few weeks.
Yep, would not agree more. Okay, so I'm going to interrupt just a little bit to remind folks and then show some charts as well and then answer some questions. So first and foremost, this, for those who may or may not know, is our macro focused product called Edge. I run what's called Club, and then we have kind of a beginner level Discord service called Community. Craig manages this product, so definitely, and this is end of month, we have a kind of a one-day special where 20% off if you are interested in having this concierge one-on-one with Craig, also myself, but especially with Craig. I mean, he is with Edge clients every single day, kind of navigating what's coming up, how to manage the event risk, portfolio construction, the whole 9 yards, actual trade setups. He does a weekly Edge roundup. We also do our weekly webinars with clients. So this one we're kind of making available to the public. I just want to let you know about this kind of promo offer, 20% off. Please definitely seriously consider. All right. And then what I want to also show on getting ready for this dramatic day, I had posted this for clients, and this was literally yesterday, January 30th. The whole idea was that be careful of risk coming in. If we broke this 49.06, that was the trigger to go short into, and hopefully you can see this a little bit better. Make this a little bit bigger. I want to show you the before and after. You can see this level 48.66 and change, 48.41-ish. All right, so what are we looking at right now? We are now into a beautiful tag you're it. We literally opened after the earnings last night and then opened this morning. The go short trigger was very, very clear at this 49.06 level. And we literally have come on down and tagged almost two of the price targets that I just kind of gave to clients yesterday in yellow. Also the same thing with the Qs. We actually had, I had posted this level as well, which is we break inside 423. First price target's 420, then 421, then we're going to come back down into this kind of 413 gap fill with some potential for more. Now, even though this is volatility inducing, and you know what we have right now, right? This was a beautiful pullback in the Qs. So you know what's going on. So I run a live trading room, so obviously we can do this real time. And I also had the Fed FOMC meeting today open for clients from 2 to 3. But the point is, it's working. Volatility, however, is usually a short-term kind of burst. So not expecting that we're going to go completely down and fill up all of those lovely gaps, but we'll definitely give it a good college try. And then ultimately, once we get through this volatility, there isn't really, unless we get another reason for a sustained sell-off, we could just as easily go right back up and tag those higher price targets of 5,000. So I'm not ruling this out. I definitely see this as shake and bake, expected volatility, but we still have some higher levels ahead that we could absolutely go and get. But VIX is a big deal right now. So, and the reason I say that is if we get more than a 2% drawdown in SPY, we actually have some forced selling that can trigger in CTAs. So definitely take care of positioning. Obviously, swing and trend portfolios have to kind of really be mindful. But otherwise, we have not broken the trends. So I know that today was eventful as it relates to cuts being pulled back, the bank drama with New York Community Bank, not to mention QRA being a little bit more hawkish, Fed, obviously being a lot more hawkish. But long story short, we don't really have a reason other than unwinding some of these cuts potentially to sell off in dramatic fashion until we get some solid forced selling, and that won't really trigger until we get a 2% drawdown solidly in SPY. All right, so we got a few questions. Let me just kind of read that off, and then Craig, what do you think? Alex is asking, given rate cuts at least starting in the second half of 2024, as well as the outlook for debt issuance by the Treasury, how do you see the 10-year yield moving this year?
Yeah, look, I mean, we are, and continue to be in a situation where the yield curve is, remains pretty flat, inverted on some durations. To 2s, 10s has been negative 30 basis points, but it's come, from negative 100 back to where we were in the summer. What I see happening is I see a significant yield curve steepener developing over the course of this year and into next year, because I fundamentally believe we are in a more structural inflationary environment for longer. Deglobalization trends, political issues, demographic impact on labor force, lack of capex in commodity investment, I think is going to lead to a higher inflationary environment in the future than we saw in the past. And I also see a U.S. government debt situation and deficit situation, which doesn't appear to be getting any better anytime soon. And so continued big deficits, inflation makes me concerned about the back end of the U.S. bond market. And so I would anticipate that we will get long end yields higher later on this year. That being said, to the extent we have the market correction, risk asset correction right now, and a slowdown that leads to a Fed cutting cycle, we could get a bull steepener, in which case, front end yields move lower, 10-year yields move lower as well, but not as fast as the front end comes down. So that would lead to, this curve continuing to steepen, but the absolute level of the 10-year could come down first, right? If we have a risk-off event, over the course of the next 6 weeks, which is my base case, could we get the 10-year down towards, below the low that we saw at the end of December, which was, 375 or 380, let's say. Yeah, sure. I think we could. I think it would be a great place to be putting on longer term shorts in 10 years. So, I don't think there's much in the way of a trade right now. But I've been looking to get short 10-year, expecting higher yields later, for later on this year.
And TNX broke its uptrend, not just today. It actually broke weeks ago, by the way, Zon. So this is very much, for me anyway, expected from that 5% down to 4. It overshot to 3.8, and now it's just squirreling around the 200-day. So 3.8 up to 4.3 is going to be a range where I think we're going to hit our head on the 10-year, head back down, go back up for the next few quarters. End of year, very different situation. And then, of course, how does it go for the election? That will also, policies dictate price, and they'll start to price in some of that. Is it continuation of policies, or do we have, new sheriff in town type of thing? Then that'll start to move large. And also the Fed, if they don't cut or they do cut, I mean, we have time until the end of the year. So the 10-year yield, he's asking below 4%. Is it good for the market? In other words, yes, we did kind of break here. Let me just show you real quick, a little granular chart, but I will show you if you can see it right here. So here's the dollar index. Obviously, I have this up. It's on the 2-hour, but you'll get the feel. Obviously, what happened today with the markets, and then over here we've got the 10-year. This is crude, that's oil. But let's just blow this one up, and you can see where we came and hit that 5, rolled over very firmly. This 4.9 was line in the sand for me. If we were going to roll over, we're going to head back down to 4. We overshot to 3.8. That happens to be a really significant level as well. Just as strong as the 5-year, the yearly at 5%. And we have since rolled back lower below that 4.1, but I wouldn't rule that completely out from heading higher on the 10-year. I just think it's going to kind of squiggle around that 4.1. What's your view on the 10-year, and when is it, bearish as it falls?
Yeah, look, I think the Fed and I'll say the administration together, but I don't think either those entities are desirous of seeing an economy that really implodes ahead of the election. And so I think to the extent that we were to get a risk-off scenario where bonds are rallying, with that, I think, and people are concerned about growth, I think what you're going to wind up seeing is we're hearing more about that the Fed's ready to cut and they're ready to reflate, which is why I'd be bearish on the 10-year kind of at that point. And so I guess basically what I'm saying is I think you could see a 10-year in the next 60 days or so, through the end of this quarter, back down in the 350 to 375 camp. But that would be market bearish, right? That would be stocks bearish. Because that would be some sort of recognition that growth is deteriorating, inflation is deteriorating very rapidly, and the Fed is not doing anything much about it. That'd be some sort of big bear flattener first, and then as the market starts to deteriorate and as folks start to get more concerned, then there'd be this expectation of a Fed pivot. And at that point, you want to get short treasuries. So that's kind of how I see it. If how could I be wrong? I guess I could be wrong if we have an economy that just kind of powers through everything. There's no slowdown. The labor data that we get this week is gangbuster, 300,000 jobs, and the next CPI print shows a reacceleration, which basically suggests that the Fed is kind of really wrong here. And that the economy is not slowing. It's actually reaccelerating. The government deficits are a huge deal. The drop in oil prices has meant real consumption trends are improving and wages are high. And then at that point, we could just, bond yields could just kind of move, reasonably higher. We'd go back to, above 4%, quite quickly, or back above, 450 pretty quickly. So I view that as a less likely. I don't really think the economy is significantly reaccelerating here, but the wealth effect stuff that we've gotten from this move in risk assets has been a big deal. And maybe people are feeling legitimately more confident. I'm not so sure. We're definitely hearing a little bit more about layoffs, at least through this earnings season across the board, where it was UPS and FedEx laying people off, and some of the tech companies laying people off. So I think that trend has started. I think I saw somewhere 100,000 layoffs have been announced for the month of January, which is a decent pickup. So so I don't really think we're going to get that macroeconomic reacceleration, but I guess it's possible. And if you combine that with, let's say, a massive China stimulus, then which I don't really think is a high probability event, but it's possible. That's how you could get a 10-year yield up sooner. But I think it's more likely bonds could rally with risk off, and then at the point of Fed capitulation, you would look to start to sell treasuries again.
All right. So I was asked if I'm kind of bullish or bearish on this view. So I want to show you what I literally posted. All right, so clients know this. I believe that the market is overbought but not broken. That's been several weeks of posting that. And then before the FOMC QRA event, this is obviously back on the 26th, I said best swag. All right, after a burst of volatility, likely from confused market as Yellen issues slightly more longer duration bonds over T-bills and Fed intonates more normative cuts in the future. So right here, right now, this is the volatility surge we're getting. I think that the market will continue higher into about, 444 for the Qs, 53.40 for SPY, and small caps will do fine. Now, obviously, that's if then. If we get some outsized volatility, all bets are off. But let me just kind of show you something else, which is the trend of Nasdaq. I mean, clearly, and by the way, you don't know, but these are monthly levels. So if, we had this major short covering rally the first week of November because of the Fed put and the Yellen Yahtzee, which was basically Fed pause. They've now had 4 meetings where they haven't done anything with rates, right? And then Yellen, of course, issued tons of T-bills over the longer duration, and we just had liquidity infused higher, short covering, and everything is fine and dandy. This particular trend has not busted. So all is still very likely to come back down and retest. I'm expecting volatility, but then I expect it is likely to get bid back up again. I am particularly excited about more of the value plays underneath the surface, honestly. So the portfolio is mostly long for multi-month trends, lots and lots of value. Swings can be long or short, growth or value. And then the chase is whatever moves, right? So the point is, even SPX, it is staying very firmly above some key levels. Same thing. This is the 10-week. This is a quarterly level. I like these levels. I expect them to be retested, but I don't expect the market to freak out until it has a reason to. So timing volatility, right here, right now, it's working. The charts that I literally gave, clients for the Nasdaq and SPY. Okay, great. We just needed a trigger. We had some, weak guidance by the big tech that reported Tuesday. We had this, lovely, digestion of cuts being priced out. Doesn't mean Fed is not going to cut in March, but right now they've got no reason to. But things can change. The market right now, to me, is just a volatility induced sell-off that will get bought. So hope that answers that question. And then a question came in by Tammy Craig that says, what is your view of liquidity and yield effect on commodities and dollar index?
So with respect to the Fed, liquidity, QT is continuing, 60 billion a month of Treasury QT, at least, what I think certainly through March and probably through May. Maybe we start to see a bit of a step down in June or in July, but it will still see a balance sheet reduction. Look, bank reserves have grown significantly over the course of the last year as the money from the RRP has gone into bank reserves. So bank reserves are fine, but overall liquidity is declining. And when Treasury announces, like it did today, that they're going to be doing a net issuance, duration issuance increase, that does remove liquidity from the risk markets, because there's higher risk ratings associated with buying duration than buying bills, and so it kind of takes overall leverage out of the system. I mean, we have the ECB is withdrawing liquidity still. Japan is back and forth, saga with the BOJ. I mean, I still think they're more likely to end a negative rate regime this year, which would be extracting liquidity as well. China is adding liquidity, but it needs to add a lot more liquidity in order for it to have a profound effect on equities and on its economy. So I still broadly think we're in a position where liquidity is being drained. But as we push through this year and start to exit the year, we're going to be in a position where as we get rate cuts, as we get the end of QT, the incremental and second derivative of liquidity is going to start be additive again. And it's at that point when inflation, certainly commodity inflation, will start to reaccelerate. So I think we're early on a commodity, keep the gold to one side, on a base metal, a bulk metal, and energy. I think there is a story there as we push through into the second half of this year and into 2025. I think that is a much more bullish backdrop for commodities as the dollar weakens and as liquidity is brought back. I just think we're I think we're early to that trade.
All right. And then question on Tesla. Okay, well, I have 167 as a price target for Tesla, and then we'll see. Oh, wait a minute, I gotta do this little thing that's called share. And then definitely everyone has their own kind of time frame, but this, it's not a macro tell, obviously, but this is just kind of a key level of 167.5, which has been an area of support. So that's where I'm looking for kind of a relatively short-term intermediate low for Tesla, if that helps. So is it done? I don't know about that, but definitely expect a bounce at 167.5. Question. Oh, small caps. Okay, view on small caps. Craig, I'll then give mine.
Can I share my screen on this real quick?
Oh, yeah, of course. Sorry, I didn't.
Oh, I'm disabled. Try again. Hopefully you can see that chart. So that's a chart of IWM versus SPY, dating back to, beginning of 2021. Now you can go back pre-COVID. I mean, it just doesn't look like a chart you want to buy still. So even from a technical setup, like I don't really see a rotation into small caps developing. I don't see a broadening out of this rally into small caps because I don't see the potential for small cap earnings re-acceleration in an environment where, labor market remains tight, wages are moving higher, and growth momentum is potentially decelerating. So yes, I can understand why folks may think, well, if we're selling Mag 7, we have to buy something. So let's rotate into smaller caps. But I think what we've seen this earnings season, if you look at, the more cyclical equity names, which is small caps, correlate to better, whether it's the DuPont or UPS or 3M or, some more of those names, like the earnings just are not coming through. The earnings growth outlooks are just not great. So what I think winds up happening in this bout of risk off is we just wind up getting a beta move to the downside where maybe small caps relatively outperform big tech, modestly, but they both go down. So I don't really think that's like a bullish case for small caps. I think you'd want to buy small caps when you believe that the Fed is closer to the end of their easing cycle rather than the beginning of the easing cycle. Because closer to the end of the easing cycle, that means that they feel like they put enough accommodation back into the economy. Growth is about to reaccelerate. Inflation's likely to move higher, and earnings expectations are likely to positively surprise. That would be a more constructive backdrop for small caps, and I don't really anticipate that necessarily happening until the end of 2024 at the earliest.
All right, let me just show two charts, kind of short duration for small caps and wider. Hopefully you can see this. Did I take it? Yeah, I did. Okay. This is just a growth value ratio, and this is showing that obviously since Tuesday, we've had a pullback in some key Mag 7 or Mag 10 stocks, and value has held up relatively better. This is a kind of a short-term indicator that I use to follow rotation as it relates to basically positioning short in Nasdaq. So I use that very, very often to more often trade the Qs short rather than small caps long. Case in point, take a look, right? This is small caps today. Boom, down 2.44%. This is on a daily. I will change my tune very, very loudly when and if this is the Russell, for example, when and if we can get back above this 201 and stick that landing. We have been sideways. Look at this channel, right? I mean, this is really just unproductive since all of 2022, 2023. We're into 2024. And yes, everything moved higher in November, right? With the Fed pause and Yellen Yahtzee. But ultimately, this has to get and stay above 201 to really kind of fill some of this gap and be an outperformer. So, but big picture, yeah, this just failed miserably today. along with the market. And I would say it's a better tell, growth to value, as when to go short the Qs versus small caps as a bundle trade. Having said that, I still have a lot of oversold value plays that I like tremendously. And NYC's doing much, much better, by the way. So, relatively speaking, for those who like the composite index, NYC has not broken its trend. It's firm. So it depends on the time frame. All right, dollar yen. I think that is you kind of address that their normative policy. You don't expect that before April. And then once it happens, it does worry the market because of the carry trade unwind. You want to speak to that briefly?
Yeah, I mean, we had a big move today in dollar yen stronger. I mean, I think that was, similar to the stuff I mentioned earlier about the bond market with the regional bank issue and maybe this weaker ECI number. But broadly speaking, the growth differentials seem like they're still favoring the U.S. and the yield differentials still favor U.S. And so I'd say, and I'm biased to think that I think dollar yen should move higher. But historically, when we get pretty violent risk off moves, which I think is possible here for the next 6 to 8 weeks, at least through March expiry, we could see the dollar weaken against the yen, but I think the dollar would strengthen against the euro and EMFX and other currencies. So I guess the dollar yen now is more of a risk gauge, I think, near term here than necessarily something about policies. I don't think we're going to hear anything too specific from the BOJ imminently. There was some Japanese macro data out last night, which was actually not very good on the growth side. So, maybe the impetus to raise rates has declined a little bit, but at some point they're getting off zero. I just don't really have a great sense, nor do I think I have much of an edge trying to figure that out. So it's kind of more like the range bound type of thing. And look, if dollar yen gets very strong, we get above 150 again, the risk of intervention rises. And I suspect if dollar yen gets too low, then that's a concern for Japan too. So they'll push the other way. So I think it's kind of not that interesting, maybe not such a big driver of macro right now, where there certainly are times when dollar yen is a big driver. I don't think that it's a huge driver right now.
And I would say April, that's, the expectation that a lot will be decided from the next QRA. And then obviously Bank of Japan, there's some expectations about normative moves in April, but we'll see. They keep pushing it off. And with their inflation data, they don't really have to be in a hurry.
Yeah.
So that's basically in a nutshell. All right, CPI, any expectations? And I think that's it, because we answered pretty much everyone's question and covered the big kind of macro moves of the day from QRA and FOMC and earnings. We still have tomorrow night and non-farm payrolls on Friday morning, but CPI is a big one for you. Anything else?
Yeah, look, I mean, the next CPI reading is February 13th, and it will reflect the January data. There is a big gap between CPI and core PCE. And so I think even though the Fed talks a lot about core PCE, and that's clearly what they model in the SEP, and they give a forecast for that, it's difficult for them to kind of justify, I think, to the public or to everybody, like why they're cutting rates because CPI is down at 2 when PCE is down at 2, when CPI is still closer to 4, right? Like they're like, even though they would say, well, there's some statistical issues with CPI and that's why core PCE, it's like the public is not stupid the public is not as stupid as the Fed and the administration thinks they are. It's like people don't necessarily believe that inflation is really coming down as rapidly as what core PCE might be suggesting. And so I think there's risk that if that core CPI figure continues to run, and that's super core basically is the core CPI without services, core services inflation without housing and without energy, right? That's been running above 4%. And it was another tick up in December. And so if we get another one of those readings that are high in January, it just shows that services inflation is staying stickier for longer. And that is, I think, a concern for the Fed. And so, look, I think if that's the type of data point that we get, And that would come because we saw another, very robust market performance in January, which likely kept consumption high and service ISM high. Then it's possible that that number just doesn't decelerate as rapidly as this core PCE number decelerate. And that makes it harder for the Fed, right? They don't want to be just seen as cherry picking one data point that looks good, that fits their mandate, when other data points maybe suggest a different outlook. And that's just going to, again, back to my earlier point about buying time, it's just going to create an environment where they feel like they just need to buy more time until we get the inflation down. But look, if that number comes in incredibly tepid and soft and really shows that inflation has been slayed, then look, I think that will bring the odds up again of a potential for a March cut. So we are going to continue to trade non-farm payrolls and CPI, and that's going to move the odds, of cutting. And we're still going to have to listen to all the Fed speak that's going to come starting Friday. And, every Fed speaker is going to be out there next week. And we're going to have to hear who was on board with this decision and who's not. And are they taking up their expectations? Or, the song and dance will remain a big driver, particularly when earnings season is over. So the market does become more macro in February than micro, and we'll have to manage that and manage the flows dynamics as we get closer to expiry and after expiry. So all these things kind of matter.
Yeah. And February is traditionally weak seasonally speaking. So, all right. Well, thank you so much for joining. Again, Macro to Micro Power Hour, Samantha LaDuc, Craig Shapiro. Very grateful that you joined, and we wish you a great rest of the trading week. Bye-bye.
Thanks. Take care. Bye-bye.
Subscribe to LaDuc Trading YouTube channel for more macro to micro power hour videos and other content.